Hi, everyone. I'm Anna. I've been working on all things stablecoins at Solana Foundation for the last 2 years. And now I'm starting my own project called Perenna. So today it will be more of a third-party opinion talk on stablecoins as monetary infrastructure, why we should care about infrastructure for stablecoins from the angle of national defense. So this stable conference is very EVM and DeFi focused. So I thought instead of giving another talk on stablecoin design, I might as well talk about a very niche topic that I think more people should care about. So disclaimer here is that I do not necessarily support stablecoins use for national defense or for geopolitics. It's more just an objective reality that this is happening, and I think more people should care about it. So the fact is, people want dollars. Not something that I'm not American, so this is not a patriarchy or anything, but the market has spoken, and many times. So the last year, I basically spent a year trying to bring non-USD stablecoins to Solana. I brought on a number of stablecoins from CHF, EUR to AUD, but we just haven't seen that level of market demand. In the end, 99% of the 166 billion of stablecoins issued is dollars. And I think not only do people want dollars due to liquidity for trading, but people also want dollars because they want to escape from their dysfunctional and extractive currencies in their own country. Preserving and expanding that conduit from bearer currency, which is cash, to fiat, bank custodied fiat, which is subject to capital control, to stablecoins, which is as far as it goes now, the freest form of currency that could exist, is paramount to helping people get out of the evil and extractive financial systems that they are a part of. So giving people access to the dollar is a public good, and one that is also insanely beneficial to the United States. As an aside, I wish we were not so globally reliant on the dollar's overwhelming dominance. I wish we have other currencies that are counteracting the dollar's growing penetration globally. And I think this is why this talk is to raise awareness for other jurisdictions and regulators, such as for RMB, EUR, or even CHF, to be more supportive of stablecoin innovation. And I think like RMB, EUR are two where they could play a part in financial accessibility, but not with the attitude that the current regime has. So we just celebrated the 4th of July where I live in the States. Took me a couple of years to succumb to this acceptance of freedom constitutes of military ability to attract and retain talent and the dollar hegemony. So I think the narrative of stablecoins as defense tech is a very small but growing narrative. And there are roughly, I think, 3 companies that have talked about this so far. So there's Austin Campbell, who was the reserve manager at Paxos, chief risk officer. He spoke about stablecoins as defense tech from Zero Knowledge Consulting, which is his firm. Inca Digital is also in close contact with the US government, speaking about this and testifying in front of Congress. NFX, so Morgan is the co-creator of Diem. She has also been advocating for stablecoins as defense tech. Again, this is not to say that we should use this for military power, but to say that this is something we cannot ignore, even though everybody here is interested in DeFi, and I also love DeFi. But this is just an angle that it would be beneficial for everybody to be aware of. So with that in mind, the current monetary stack is super jank, both from a TradFi perspective, which we've been building on top of century-old legacy tech and innovating iteratively on top of that, but also because a stablecoin world in DeFi and beyond DeFi in the blockchain space is shaping up to be hyper concentrated and not conducive to growth. So out of the total issuance, 166 billion, 160 billion being, roughly speaking, being fiat backed. So decentralized stablecoins have not really gotten a lot of market share. But also, more importantly, 155 billion of those are from two companies. There's Tether and there's Circle. So you're looking at this basically, it's a country with two banks. Even Iceland has 3 banks, and this is highly problematic because when you have 2 banks and one of them has issues, whether it's DPEG or whether they are simply expressing their opinions in a way that is not very welcoming to other issuers or other participants in the market. For example, it's very common for people to spend more than 6 months waiting for a Circle account. And if those are the only 2 options that you have, it is very hard to scale this ecosystem. So both issuance and existing market structures are not conducive to scaling the stablecoin issuance and therefore the stablecoin based economy, which is currently mostly in crypto DeFi, but I think it goes well beyond DeFi. So I think there are 3 macro trends that show us support why we need infrastructure now. So the first one is a lot of issuers are coming to the market, regardless of this challenge that majority of the stablecoins are backed by duopoly. So whether it's USD, GBP, HKD, CHF, and beyond, in the fiat-backed world, there are a ton of issuers coming, and this is not even counting the non-cash and cash equivalents stablecoin issuers. So a couple of the speakers here, for example, Agora, M0, Mountain, they're all in the cash and cash equivalents space, backed by T-bills or overnight repo and cash. But there's a ton of issuers also working on backing stablecoins with commodities, real estate, and so on and so forth. The second trend is that the newcomers are playing with yield. So the speakers at Stable Summit I just mentioned, these guys are all very willing to give out yield. So the market, I think, will go through an economic realignment among stakeholders. It is unfair for us to be taking on counterparty risk from the issuer if the issuer is not paying us anything. It doesn't happen really in any other mature financial market. And this is a weird situation for crypto. So I believe infrastructure can help propel that change. The third trend is that stablecoins will continue to grow and expand beyond DeFi trading. I know we're at ECC, but majority of peer-to-peer volume, a lot of it is on Tron and Ton and Solana. All of those folks are perhaps not very present here. But we're focused on use cases, not just in DeFi, but also beyond. And a lot of that means payments. So the current stack is underfunded, underexplored, and adversary to having new issuers, having Forex. Also, it doesn't scale first-party rails, aka the issuer mint and redemption, because everything is super siloed. So our peers at M0, which presented earlier this morning, they're reimagining the monetary stack by owning and extrapolating the complexity out of a lot of the stack. However, this is roughly speaking, I drew it last night. So like the current stack looks like all the different players, and as an issuer or as a market stakeholder, you don't really have a place to help you grow. You're competing very much upstream. Just from let's start from the TradFi level. So there are custodians, there are auditors, there's banking and payment rails. But as an issuer, you have to go source all of these, and none of them are really supporting issuers the way, let's say, a stablecoin launchpad could be. On the CeFi side, issuance as a service, there's Paxos, Braille, and Bridge, regulatory disclosure, Chris Brummer out of DC is building a regulatory disclosure as a service firm, but largely speaking, most issuers are still spending a lot of money on compliance on their own. Most of them are in-house. On the third-party Rails side, there are a ton of them. There's like MoonPay, Transact, Mercurial, Unlimited, etc. But almost none of them are specifically focused on stablecoins. So even if, as a user, so I live in the US, which is fairly easy to on and off ramp if you're willing to fully KYC. But if you're in other countries, there are a lot of places that are really, really difficult to get into and out of stablecoins. And almost no provider is purely focused on this. The other big problem is if I'm an issuer and all of you are issuers, we are not really collaboratively scaling the stablecoin economy because my issuance doesn't talk to your issuance. You don't accept my stablecoin. However, why Visa is so powerful is because now I can go anywhere in the world and I can pay with my Visa card and your bank is willing to accept that. So I think this is the part of the infrastructure that's missing. On the DeFi side, there are also a lot of missing infrastructure. I spent 2 years helping issuers coming to Solana, and every time an issuer comes, they have to set up their own, just from the smart contract perspective, all the way to liquidity, their own stablecoin liquidity pool, their own integration. They go do all the BD, which is not really necessary for most of the issuers because maybe their value prop is in payments. Like PayPal is more used for merchants than they should be used on DeFi. Why do they have to do what everybody else is doing, which is putting up half of their liquidity, principal liquidity that is, at a cost of capital closer to 10% or maybe more on chain, not earning yield and giving that yield to Circle, when they could be pulling together resources with other issuers together in the form of, say, a balancer pool where 5 issuers are sharing that common source of liquidity. There are other categorical infrastructure players that I think are underexplored at the moment, whether it's the integration layer, clearinghouse model, or dark pools, which my friends at Mac Exchange, which are previously known as Hourglass, they're exploring. But a lot of those hidden liquidity is still on OTC markets where it's very much institutionalized, it's opaque. Again, we're going back to this sense of TradFi, century-old tech, and not opening up liquidity to the masses. So what are we doing? We're building decentralized infrastructure for money. I think the monetary tech revolution is just beginning. I'm not trying to take on every aspect of the monetary stack, but just focusing on one aspect, which is the increased capital efficiency for on-chain money. I think of money as at rest and at work. So CDP in my mind is at rest because the money in the vault are sitting there doing nothing. Stable swaps are money at work, but the at work efficiency compared to TradFi is extremely low. So if you look at stable swap AMMs, the on-chain 24-hour turnover is less than 5x. In a TradFi market for FX, or even for spot, the turnover, 24-hour turnover of principal capital is maybe 50x or more. So we're super early. Like, for us to talk about DeFi as a capital efficient open market is a travesty because we're actually less efficient than TradFi in many ways. So I'm setting out to do research and building infrastructure to address that small but growing pains, as well as I'm sure a lot of the other people here building DeFi markets are trying to do as well. But why DeFi? DeFi is cool, but PayFi is cooler. So if you think about it, trading is value transfer in its purest form. I send you a financial asset, and you send me back another financial asset. That accounts for roughly 20% of the GDP, and that's already the 20% is super high in the US. For other countries, that accounts for much less of the GDP. So the rest of the 80% of the GDP, you're looking at, I'm paying you with a financial asset, and you're paying me back, you're transacting with me with a non-financial asset. So that part of the GDP and economy, we largely have not touched. It's been touched by Tron a lot, and I think Tron has a very good chance at tackling that market. But for Ethereum and Solana, largely speaking, we've not touched that. It is super interesting for me because PayFi, like supply chain financing, is really, it's broader, The underwriting takes forever. Liquidity is opaque. It is super hard to use, especially in emerging markets where in LATAM, you're talking about 20% plus cost of capital to get payments financing. So this is a concept that at Solana Foundation, we started talking about in the last couple of months, is how to enable DeFi for payments use cases. And I think this is a super nascent, but again, why it kind of goes back to the topic of my talk today, which is stablecoins is defense technology, because in the end, it goes back to growing, protecting, and supporting each country's local economy. So this is a very roundabout way of saying stablecoins need infrastructure. We need infrastructure not because for ourselves, for our countries, but also for geopolitical stability and for global accessibility to a functional currency that is currently the dollar, but it doesn't mean that it forever has to be the dollar. And I hope that a good portion of the economy can run on this new monetary stack. Thank you.